Act 1. The Ominous Calm. 2007 marked the early signs of a brewing financial storm. Subprime mortgage defaults were rising as adjustable-rate loans reset at higher interest rates. Mortgage-backed securities, once considered safe, began to lose value. Analysts warned that the U.S. housing market could trigger broader financial instability, but the scale of the coming crisis remained largely underestimated. January 15th through the 19th, 2008. Reports emerged of increasing mortgage delinquencies at major banks. The Dow Jones hovered around 12,700, the S&P 500 at 1,370, and the Nasdaq near 2,400. Credit spreads widened, indicating rising concern in the lending markets. March 10th to the 14th. Bear Stearns' two hedge funds collapsed due to heavy exposure to subprime mortgages. Rumors spread that the bank itself could face liquidity issues. By March 14th, the Federal Reserve arranged a $30 billion emergency loan, allowing J.P. Morgan Chase to acquire Bear Stearns for $2 per share, down from over $60 just months earlier. The VIX Volatility Index spiked above 50, signaling extreme investor fear. Act 2. The cracks widen. April 14th to the 18th. Lehman Brothers and Merrill Lynch reported multi-billion-dollar losses. The TED spread, measuring the fear in interbank lending, widened above 200 basis points. The S&P 500 fell below 1,300 points. July 7th to the 11th. Countrywide Financial, the largest U.S. mortgage lender, announced $1.5 billion in losses. Bank of America stepped in to acquire the distressed firm. Foreclosures continued to climb nationwide. August 4th to the 8th. The U.S. government placed Fannie Mae and Freddie Mac under conservatorship to prevent a total collapse. The Dow fell 300 points in 48 hours. European banks began revealing their own deep losses from U.S. mortgage exposure. The credit markets were freezing over. Act 3. The Total Meltdown. September 8th to the 12th. AIG disclosed near insolvency due to credit default swap exposure. The Fed approved a massive $85 billion emergency loan to keep the insurance giant alive. September 15th, 2008. Pause for effect. Lehman Brothers declared bankruptcy. No buyer, no government assistance. The Dow plunged 504 points. The Nasdaq dropped 6%. Interbank lending froze completely. Money market funds faced a run. Days later, Merrill Lynch was sold to Bank of America in a desperate bid for survival. Globally, the FTSE 100 and the Nikkei plummeted. September 16th to the 19th. The slide continued. The Dow fell to 10,600. The VIX spiked above 60. Investors panicked, withdrawing funds at a rate that triggered temporary interventions by the U.S. Treasury. October 6th, 2008. The Dow experienced a historic one-day drop of 777 points, the largest at that time. Congress passed TARP, authorizing $700 billion to recapitalize banks. Central banks globally coordinated emergency liquidity injections. Through the rest of October, the markets remained in a fever dream. The VIX hovered near 70. Governments intervened with capital injections and temporary nationalizations to prevent a total global blackout. By November, TARP funds were deployed. Credit markets stabilized, slowly, but the damage to the real economy was done. Unemployment rose as businesses began failing worldwide. Act 5. The Bottom and the Aftermath. December 2008. The Federal Reserve turned to quantitative easing. The recession deepened, with unemployment reaching 7.2%. Early 2009, the American Recovery and Reinvestment Act injected $787 billion into the economy, yet the bleeding continued. By March 2009, the markets hit rock bottom. The S&P 500 stood at 676, the Dow at 6,547. Mid-2009, finally a rebound. The S&P recovered to 1,000 points. The Dow rose back above 9,000. But the scars remained. Unemployment peaked above 9%. Regulatory reforms, including the Dodd-Frank Act, were introduced to ensure this would never happen again.
The 2008 financial crisis demonstrated the fragility of the global system. Excessive risk-taking and complex instruments transformed a housing correction into a worldwide collapse. Millions lost their homes. Retirement savings were wiped out. This timeline shows just how fast confidence can evaporate. It is a stark lesson in the cost of unchecked greed and the devastating price of poor oversight.